have taken the definition of VC funded companies to be those of less than 10 years and which have raised funding up to Series F. And also, we have taken late stage tech companies in the particular definition. So here is a snapshot of the VC funded companies. So these are, the final bar here represents the 9-month data for 2022, which is already higher than the previous years. Except for 2021. And as my colleague pointed out, 2022 is a good year for the ecosystem. So seeing the data from the sector focus, this different action in the different sectors. So enterprise software is thriving and the figures are already higher than 2021. Fintech and e-commerce have come down, but also minimally. And overall, enterprise software, deep tech, healthcare, and especially biotech are big gainers compared to last year, which was dominated completely by unicorns and mostly by consumer technology companies. So zooming into the data by stage, the seed and series A are actually thriving still. As of date, we are seeing on a daily basis more and more seed stage investments happening. And Series B and beyond seem to be dull and as we all very well know. Moving on, this slide is more of a double click on seed and Series A stages, which is represented as early stage and angel investments here. And they are kind of tracking very well. And again, the point is the fall is not an actual fall. As you see, the numbers are already 573 and 545, which is at the 9-month mark, which is way higher than the previous years. And we will probably end 2021 significantly closer. 2022 significantly closer to 2021. As we move, we are actually seeing quite an interesting churn in terms of the most active investors at this stage and the early stage. Typically, as you all know, Bloom Ventures, Sequoia Capital, Kalari are all traditional investors who are active in the list and who still remain active. But this year we have seen new names like Better Capital, which is a seed fund, and InfoEdge, which is a strategic fund, making a mark through the new investments done into new companies, and they've made it into the top 10 list. So here is a interesting analysis we have done quite recently on the companies that have raised funding, seed funding, in between 2015 to 2021, and basically what happened to them subsequently. So we took a set and we kind of saw how many made successful Series A investments, and then out of those, how many made raised Series B, and so on and so forth. So as you see, from 2,863 companies which raised seed funding, only 521 raised Series A, and out of which 174 raised Series B, and which funneled down to 25 who raised Series C plus funding. The report, the Series A landscape report, is available on our website in the free section. You're free to download the same and give us a feedback on the same. So that's about it. So I'll kick off the session, and I'd like to call the panelists on stage. Mr. Jain, partner Trilegal. Mr. Pratik Sethi, head New Age and Digital Business, Ambit Investment Banking. Mr. Vishesh Rajaram, Managing Partner, Speciale Invest. Mr. Vamesh Chovatia, Partner, Tata Capital Healthcare Fund. Mr. Abhishek Sharman, Founder and Managing Director, Carpediem Capital. And Mr. Sanjay Mehta, Founder and Partner, 100x VC. Before we kick off the panel, I would like to invite to the podium Divyesh Dayal and Kunal Tijoriwala of DBS to provide an interactive view on how the bank is working with both investors and startups that they back.
This one. People are able to see that? Yeah. We want to play the video first. We can keep this open. Yeah, this one. I want to just say in this 2 minutes, then we'll start. Hi. Good afternoon, ladies and gentlemen, and esteemed panelists. On behalf of my colleagues at DBS, I welcome you all. We'll be giving you a short overview on DBS as a bank. So we'll play a couple of videos, and there's a very short presentation.
Focus on you. So it is about you, the customer. And we will focus relentlessly on you and your life. And if we can do that, and we can dare to think about how you need to live your life, then we can shrink the space that the bank needs to occupy. We can make it easier for you, we can give you the tools, we can give you the time, and we can give you the resources to lead a more full
We lived apart because that was the way things were. Then, times changed. With more and more and more at your fingertips, you needed to come to us less and less and less. But we also knew, even though you needed less of an old-fashioned bank, you'd need more banking than ever for all the things that matter to you. After all, you bank to live, not live to bank. That's why we're here, with banking that has a spark of creativity. Being with you wherever life takes you, instead of taking you away from life. Focusing on you and how you live. So wherever you go, we make banking a joy. Completely natural, effortless, and often ready even before you are. A bank that brings individuals, businesses, and communities a lot more life with a lot less bank. And has the guts to stand for it. Live more, bank less.
I'll just quickly give you some overview on DBS. We are a Singapore headquartered bank. We are now a wholly owned subsidiary in India, which we did about 2 years back. My name is Kunal Tijuriwala. I head the institution clients group, and on behalf of my colleagues, I'm here to talk a little on DBS. So we are Southeast Asia's largest bank. We are listed on SGX, so our numbers are publicly available. But just to give you a glimpse, we are about $14.3 billion of revenues, which $6.8 billion of PAT. We are in over 18 markets globally, and 13 to 14 of our key markets is what you can see on the right on the panel. We have close to 340,000 customers, and our asset size is close to $86 billion. We are not new in India. We have been here for 25 years. We are here since 1994, but over the last 2 years, we have taken milestone steps. 2 years back, we got into the subsidiarization mode, which means we formed a wholly owned subsidiary in India, which now makes us DBS Bank India Limited. We are the only foreign bank that, with large business that is through a WAS model now in India. And about a year back, if you've been reading on us, we also amalgamated and bought over Lakshmi Vilas Bank. And that takes us to over more than 500 branches of DBS now in India. We We are currently present in 19 states. We have over 350 cities of presence, and we are over 500 branches now in India. So we are very uniformly spread across the Tier 1, Tier 2, Tier 3 cities in India. I'll just quickly run you through this slide. It's a bit busy, but it's just a glimpse of what we do. We are on the institutional side. We also have a large consumer business, but we provide banking support for payments and receivables. We enter account services. We do liquidity management. We have a huge treasury and FX risk management solutions. We give trade solutions. On the right-hand side, relevant to this forum, because this is a conclave, with private equities, we are a DDB participant. We have a license, and we provide custodian services for FDIs, FPIs, AIFs, and all the type of investments that come into India. This slide is more on our capabilities on FX and treasury. So we do FX, derivatives, interest rates. There are unique customized solutions for e-commerce and startups, which are nothing but investing companies into which private equities and VCs invest. There's a lot of digital platforms for us to trade on rates. And we provide a bouquet of FX services through our bank. I'll invite Vishesh, who's Managing Director of Global Transaction Services. We'll be playing a short video relevant to the custody offerings that we have, and he has a couple of slides to talk on.
Regulatory framework, you value custody and clearing services for your investments in Indian markets which maximize operational efficiency. Achieving this requires a trusted partner with new age solutions. With state-of-the-art technology, years of expertise and global insights, DBS Bank's award-winning custody and clearing services offer you the competitive edge you look for. We are a Singapore-headquartered bank with a strong custody network in Singapore, Hong Kong, Indonesia, mainland China, and India. We have been ranked as the safest bank in Asia for 11 consecutive years by Global Finance. We have been affirmed with the coveted AA- and AA1 credit ratings. We have been awarded as the world's best bank. And we have won the Best Sub-Custodian Award in 2019 from Global Finance too. With an unwavering commitment to support the needs of our clients, our custody specialists work closely with you and your advisors to provide tailored solutions for custodial and clearing needs. Our capabilities include foreign investments through custodial and clearing services, including managing your investments in equity and debt securities, and derivatives covering equities, currencies, and interest rate futures. As part of derivative clearing, we accept government securities or treasury bills for margin requirements. Advantage from our deep global insights to support your critical investment decisions. To safekeep clients' assets, we complement our services with innovative technology and reporting capabilities. Focus on your investment activity with our dedicated onshore client servicing. Benefit from real-time margin calculation and position monitoring. And through Priority Pay, enjoy seamless cross-border remittance on same day within DBS across multiple jurisdictions. As a market leader in Asian currencies, DBS offers you seamless FX deal execution and processing with competitive pricing in all major currencies. Comprehensive product suite of FX and interest rate hedging solutions. Our custody and clearing services are unrivaled in scale, precision, and quality. Rely on us to be a trusted partner to safeguard and service assets around the world. Make DBS Custody and Clearing Services the bedrock of your asset protection. For more details or queries, please write to dbilsfs@dbs.com.
Okay, am I audible? Okay, so thank you. Good afternoon, everyone. I think a big thank you to all you guys, and I think even Venture Intelligence, they've kind of pulled it off at the right time. I've been to a couple of these events in Bangalore, and I think it couldn't have been at a better time. Clearly, winter's around the corner in terms of fundraising, so there are challenges in my view. But again, I think the zeal and enthusiasm is at its all-time high. As you've noted, as a bank, I think over the last 2 years in COVID, I think we've probably grown the most in the country in terms of just the breadth, right? Right from acquiring Lakshmi Vilas Bank and now present over 560 branches in the country. So I think we have significant presence. But I think that's not the key. The most important part in my view actually derives from the fact that as an institution, we've done a lot in terms of engaging with various class of or categories of customers, right? And that stretches right from large corporates to investors, which could be private equity funds or could be FPIs, FDIs, all of this, right? So different categories of investors, AIFs, etc., all of those. But I think our ability to stretch right down to even startups as well as MSMEs. So for example, I can give you a good one wherein we've kind of engaged with Odex, one of the largest platforms in India from a shipping perspective, wherein we enable them to actually sell their services to our large corporate customers. So actually it works both ways. It's a brilliant solution wherein we also provide financing to freight forwarders. Again, a good example of how a bank can actually step in, help a startup actually drive more business. So we actually enable business rather than just clearing, your FX side or even on the investment side. So I think that's the most important in my view. So I think that's the first thing. Second is we continue to drive, our service offering through digitization, because for us, I think that's where we differentiate significantly. The live more, bankless thingy also comes from there. So customer centricity is key and paramount for us. We don't believe that the branch footprint is significantly important other than from a customer engagement point, but going digital or being digital is most important. And I often, kind of look back. I've spent over like 20 years in banking, and I can tell you that when UPI was launched, nobody thought demon will happen. Nobody thought COVID will happen. And when GST was done, nobody thought COVID will happen, and nobody would use GST information at the time of COVID to provide financing, right? So most of the digitization that has been done, in the country, thanks to the regulators, and I think the government has helped us a lot, right, significantly. And we've kind of leveraged that over a large extent, right? And that's where I think we've been able to kind of reach out to customers. A small example, again, over the last 2 years as a bank, we've got close to 4,785 suppliers through various startups. So I could give you names like C2FO, Credible, all of those that we've engaged with to actually onboard all of them in a time when banks were not able to reach out to suppliers. And these are guys who are MSMEs or SMEs wherein they were not able to kind of avail financing, right? Financing was the biggest issue, and that's where we stepped in significantly. So again, we didn't build the platform for COVID, but it just so happened that when COVID hit, we were able to still keep the wheels running and actually help the entire supply chain to kind of move significantly. So again, we've dealt with large corporates, but I think our ability to innovate using tech stacks at the central level, and also stacks that we built in Singapore, in India, to kind of leverage and see what we can do, much better than most banks in the street. So I think that's what I would like to leave you guys. I know we are running short of time, but most important for us is, I think, across custody, which we covered out here, I think we have a breadth of, service offerings, including FX. But I think the key part is, covering the entire spectrum, right from the investor to the investee company, and however small the investee company is, because of our footprint, we're able to cover well. So again, first, thanks a lot to everyone. Thanks a lot for, at least thanks for hosting this conference, and folks for turning up. And I wish that you guys have a great evening. Thank you.
Thank you, Divesh and Kunal. We'll take any questions which are there for DBS post this panel since we are slightly delayed. I'd like to introduce our moderator for the panel, Mr. Harsh Jain, partner Trilegal. Harsh Jain is a partner in the Mumbai office of Trilegal and is a part of the corporate practice group. Harsh's primary practices areas are mergers and acquisitions, structured finance, and restructurings. He advises international and domestic clients on their investments in India. Harsh has worked on acquisitions, private equity investments, joint ventures, business transfers, entry and exit strategies, corporate restructuring, and general corporate compliance. His role has involved structuring investments, drafting, reviewing, and negotiating transaction documents, conducting due diligence, and liaising with regulatory authorities. Harsh has worked closely with large financial institutions, private equity investors, hedge funds, multinational banks, domestic and multinational corporations. I'd like to hand over the session to Mr. Harsh.
Hello. Thanks a lot for the introduction. I think we're running a little late and behind schedule, so there's a lot we can talk about today. But perhaps we can start with a quick round of introductions, and maybe then we can get right into the topic. So, Pratik, you want to go first?
Hello. Can you hear me? Hello. Is it working? Okay. So I'm part of the Ambit group. I'm part of the Ambit group, and I lead the startup digital new age. Hi. So I'm part of the Ambit group, and I lead the startups digital new age investment banking business for them. And that's a practice that we've grown over the last 3.5, 4 years, and sort of in the middle of the ecosystem, seeing it from all sides and angles, and we'll talk about it more as we go along.
Hi, my name is Abhishek Sharman. I, along with two of my partners, we run a fund called Carpediem Capital. We manage about 600 crores across two funds. We focus on investing in companies which are trying to create a consumer brand or trying to create an organized service. We have invested in about 9 portfolio companies, and we're looking to add more.
This is Sanjay Mehta. I'm founder and partner at 100x.vc. We are a first check fund, investing 1.25 crore as a first check into any startup, early stage. Till now, we have a portfolio of 80 odd companies which we have funded since 2019.
Good afternoon. I'm Vamesh, Chovatia. I'm partner at the Tata Capital Limited. We manage pharma, life science, and healthcare fund. We aggregate across two funds. We manage around 200 billion. So I just wanted to see if I have to sit here or not. Hi, my name is Vishesh. I'm a co-founder at a fund called Speciale Invest. We're a pre-seed fund, very early stage. We invest in deep science and technology. We're investing across our second fund. Assets of about $70 million. Thank you.
Thanks a lot, everybody. Let me start with Pratik. It's November here already, and there's talk of a funding winter coming in. What's your take on this? You obviously see a lot of new age digital businesses. Tech stocks have taken a beating over the last year. So what's your take on this talk?
Yeah. So I think a lot's been spoken about this since the early morning sessions. I'll just summarize what was said, because most of it is part of my view as well. We'd gone used to a very exuberated 2021 where things just went almost 2x of what it was in 2020 or even 3 years before that. And if you look at all the numbers and the presentations that we've seen, this year actually will be better than pre-21 era. So in a way, both on deal count, deal volume, deal value, we still trending upwards. So what we are all seeing as a winter is nothing but the inertia or the shock when the car had accelerated from a 4th to a 6th gear, and suddenly we are back to 4th gear. So we're just feeling that we are getting a little slow.
But we're actually still on.
But we are still on the 4th gear, and right, and the economy is great. It's still macro-wise, geopolitics-wise, we are still in a relatively better situation. So things should start resuming normalcy, or at least relative normalcy as we go along. And yes, things are taking a little longer. And as again, in one of the panelists that they said, India, the venture market or the startups market cannot be pushed beyond a point. And that's what had started happening. And a lot of negative repercussions of that were being seen in businesses across, things like hiring challenges, unrealistic salaries, and which started affecting not just the startups but the traditional businesses also. So a lot of that is unraveling, and a sense of normalcy is hopefully coming back again. So the correction is good in a way. It'll bring semblance back, and as again a lot of the earlier panelists said, it gives an opportunity for startups to build more stronger businesses, better focus on the core business, on the unit economics, and more time for investors to think through and get into investments in a right and relatively fair valuations. So we remain bullish on the space.
Abhishek, what's your thoughts over the trends that you think will be seen over the next, let's say, 2 years? Do you think there's like the next big sector? Do you even believe in that sort of philosophy? Okay, this is the next big sector or next big business that VC funding will be going after. What trend-wise, what's your outlook?
See, I don't think that trends are things will change over a 6-month, 1-year horizon. I think most of the trends are already visible, and I think there is that whole aspect of tech enablement which will continue. There is more data and digitization that will continue. There is always going to be room for companies which are profitable and which focus on great unit economics. So I don't think that there's going to be some great outbreak of one area as a theme or a trend, but we obviously have cycles. So I think what is evident is that for the short term, I think late stage tech, the so-called fashionable tech companies, they're going to see a little bit of stress because investors who have that kind of appetite seem to be less ebullient. I also think that staples, consumer staples and healthcare are already seeing a lot more traction. That will continue for some time. But again, these are cycles, and I think just like we are seeing a correction of the gear moving from 6th to 4th, we'll again have some other shift of the gear that will happen. But the market is certainly going to be much more discerning, in my view. And that, I believe, is something that is going to last for the next 2-3 years. It won't be a one-size-fits-all kind of approach. If you have, whether you have tech companies, whether you have traditional companies, so to say, I think people are going to make an assessment of whether this business makes sense at a fundamental level. I mean, it may not be generating cash flows now, may do so tomorrow, but they will want to differentiate between, let's say, a Zomato and a Paytm. So I think that will play out.
Vamesh, you are obviously a healthcare focused fund. Is your experience similar? I mean, during last 2 years, there was a lot of focus on this sector, the pandemic and all. Do you see a change now, or would you echo the sentiments of the other panelists?
I would say there is a fair bit of change with regard to the B2C side of the healthcare, pharma, life science, because we cover the whole spectrum of healthcare, pharma, life sciences, medtech, med device, med equipment, digital health. So yes, there is a remarkable shift on the consumer side of the business where everybody has been forced into digitizing their operations and fulfillment when it came to customers, be it pathology lab, be it pharmacy. However, on the hospital side, if I were to say, has there been much of it? Yes, they have added the whole virtual OPD, online OPDs and all of that, and it has added to the revenue pool. But that has come off. Like 2 years has been a great year for all these guys doing virtual OPDs. And quite a few companies got set up saying we will go and digitize the hospital and get the virtual OPDs going, and hoping that that will be a trend to continue going forward. That has been not necessarily proven right. Things have fallen off the cliff with regard to those kind of models. Even in the case of pharmacies, the power of three has got established. It's now the battle is between the netmeds, the 1mgs, and pharmacies of the world. That is it. Otherwise, I remember 4 years back, every state had an e-pharmacy model being developed. And that is all coalesced into these three big boys. So similarly, I'm seeing a trend with regard to a lot of these digital businesses that have got set up, where that power of three equation will play out faster than what it would have played out in the past. So to that extent, nothing much has changed so far as the conventional delivery part is concerned, because ultimately in healthcare, it is not something like buying a shirt or buying a shoe. It's about going out there at the center and getting the service delivered. Pathology, yes, has undergone a significant radical shift, but that has only undergone a significant radical shift to the extent of the fact that where you've got health packages and that kind of stuff. But when it comes to acute, which is nearly 55% of the market, people still go to the centers and get things done, or at least get the person out to their home to get things delivered. So to that extent, there's some disruption, but not like total disruption per se that has happened with regard to the healthcare pharma life sciences. The classical pharma is continuing to build on new molecules, new discoveries. That work continues to happen. Nothing changes. Hospital delivery side, nothing changes. So I don't believe, only to the extent of the fact that it is the digitization part of the business model has got accelerated, and people who are pushing it out for next year are now looking to bring it forward. Because I don't know, very abysmal statistic, 1% of the hospital's revenue gets spent on IT. It's so terrible. Now, when you have those kind of economics, you're bound to not necessarily see, unless you are forced to the wall. COVID forced hospitals to the wall, things are changing. Are they changing sustainably for long? I'm not so sure.
Thanks. Sanjay, so let me try getting another perspective. You have, I think, a very prolific investor. We just heard about the number of portfolio companies you have just in the last 3 years. We have seen the VC space in the US as well. What do you think are some of the learnings from the VC industry, which you think, anything you see a change, some takeaways from your experiences in the US or over the last couple of years? You think, okay, this is a change which is good, or which we should also be thinking of in the industry?
No, quite a lot of them. I mean, if I have to go back on the DBS video, right, bankless, the whole idea about US or any other developed market was, how do you make your customer an employee, right? So for example, banking guys, okay, I need to go and withdraw cash. You don't need a cashier, go it from ATM, do it yourself. So they just convert all the customers into your part-time employees, right, which they don't have to pay.
Which is interesting way to.
No, even if you look at airline, right?
Yeah.
Boarding pass could print karo, check-in you do it, select the seats. I mean, they don't want to work. They want to outsource everything to the customer, right? So that's how we are learning, right? And India, everything is like, service karke, even if you send an email, the MD will ask a printout. Let me carry, I'll read it in the. So that's how we have been trained in India. So things are changing. So I see businesses which are trying to build that scale up, right? Trying to make that shift, empowering digitally, getting customers to empower and enable kind of stuff. So that's happening kind of. But still, from a velocity wise, I think we are way behind in terms of investing, decision making. I mean, we don't see great velocity in terms of within our ecosystem. It's building up. Still, if you look into it, there was a good spark which happened across in the corporate world about build versus buy, and buy was happening. The exits were happening. Again, it has fallen down the cliff. again, it's like, let's build something ourselves, right? So it will take time. I think we are maturing, we have started, but it will take good amount of time before we really catch up. But a lot of learnings from that space in terms of how do you look at deals, how do we evaluate the horizon. I mean, typical analogy or anecdotal which I use across is, you got one side telescope, right, where you can see the future and see the things which are going to come, next, and see the things very near. And that's what entrepreneurs show us. And then suddenly in the reality, we use microscopes. We start dissecting things, going back to basics, trying to find problems. And that's how, I mean, we need both of that, but that's the balance what we need to bring in.
Vishesh, you are a tech focused, and what are the kind of opportunities you are scanning, or what's your outlook? How do you see it playing?
Yeah, so I mean, there are lots of interesting themes coming out of here, right? And from our vantage point and the lens that we're looking at, we're a very early stage fund, as much as Sanjay or maybe right after them. We're typically investing $500,000 or less in companies, and our focus is on companies that have fundamental innovation on the technology side, more than the business model side, and hence they're often founders with domain experience or expertise in science backgrounds. But with that as sort of the broad background, I think the theme that is evolving as we speak is a one where supply chains globally are changing. Right? What has transpired in the last 2 years has put a lot of stress on supply chains from China specifically, and the world is definitely looking at alternatives to China. They know that other nations are not at the same level, but they're willing to invest in time, capital, and opportunity for some of these countries to look up. And India is clearly top on that list, in addition to, let's say, a Vietnam or a Bangladesh. Then it's interesting to look at, from a science and technology standpoint, where could be avenues where as a country we have historical strengths that allow us to leapfrog and deliver global technologies or global products. And a large piece of our focus is on the industrial side there. So we're early investors in electric vehicles, we're early investors in hydrogen, we're early investors in battery technologies or battery recycling. So we're trying to see, hey, could you use the industrial backbone of this country and see if you can build new products that serve them and have global requirements. So that's sort of the broad lens we're looking at. And
Sure.
for us at the moment, climate, semiconductor, space, robotics are very interesting areas, because we think all of these can bring in efficiencies and move away from the old world of industrialization to a new world of industrialization, where hopefully India is either in the center of gravity or close enough.
So let me ask you a little bit more about that, right? I mean, I think one criticism that at least we read about the Indian tech space is that a lot of it is not really innovation. They are copycat models, or they are just service providers. How much R&D is really happening in the Indian startup space? So what's your take on that?
I think there are two sides to the coin, right? Firstly, everybody wants to pluck the lowest hanging fruits. The lowest hanging fruits are large markets, which are very obvious, whose trends are very comparable to other worlds that are maybe 2-3 years ahead of you. Back in the day, the West used to be 10 years ahead of us. Now it used to be 2 years, now it's about 3-6 months, right? So the natural tendency for the investor world is to see for comparables, patterns, pattern matching, and look at investment. So I'm sure that will continue to happen. That's historically happened as well. But at the same time, in the background, in smaller numbers, there's a lot of innovation that's been going on for a long time. The country has a program called Imprint, which the central government is essentially giving grants to academia to come up with ideas. Not all will end up as startups or companies, but there's a reasonable percentage going on there. We ourselves as a fund, while we've made about 30 investments, almost 15 to 18% of that is with academia. So it's happening, it's in smaller numbers. It is, in my view, not an appropriate comparison to see how much is consumer or how much is enterprise and how much is deep tech. I think they'll all evolve. Secondly, anything on the pure deep innovation will have longer cycles. So you just have to learn to be patient, learn to put those seeds in there and plant them and see how they go.
Can I add?
Yeah.
I mean, this has been a myth. I mean, I wouldn't say we are not doing enough in terms of innovating. A lot of the West is behind what India does across, right? Simple stuff like, let me give you OTP. It's a very simple problem solution, right? Which has been there for India. We don't have thefts. Right? And today, for example, Ola started OTP, Uber had to copy.
Right.
Uber copied it. Right? We have a great mechanism on cash on delivery, which world never had. We still survived. We grew. UPI, it's just crazy. World is looking at us. Look at our government, a prime minister speaking startup. I've never heard any leader of any country talking about startups. We are in amazing space. I mean, everything is firing. The infrastructure, basically, we are a young country. We have just started. There is a lot more to happen. And we have just begun. I mean, we are comparing it's not apple to apple.
That's interesting. Which is one sort of final question on this theme before moving on to another theme. How do you talked about climate tech, space tech, and on the industrial side, and as a fund which is investing at an early stage fund, how do you look at it given that some of these areas, they're literally kind of, breaking ground for the first time. You have the world's biggest companies also doing the same thing, at least maybe not exactly the same thing, but on the face of it. So you're, like from an investor perspective, how do you view taking bets on these kind of technologies or businesses, and with that reference?
Firstly, we don't think we take bets, we think we take very informed decisions, jokes aside. But I think sort of the question you're asking, a firm like us is specifically looking for the innovation quotient and that being the differentiator. Because if you're investing in pre-seed or if you're essentially investing in a company that's a few hundred years old, we don't have a lot of competitive advantages. We don't have a balance sheet, you don't have a large team, you don't have distribution power, all of that. But then we're essentially saying, okay, do the founders know something that most folks don't know? Is there a core fundamental differentiation in the tech that we think can hold itself out? One. Two, in full disclosure, we also don't play into sectors or opportunities that need $50, $100 million to commercialize. We look at deep tech, but that the other myth is that deep tech is capital intensive, which actually it's not. So we're essentially looking at technologies which needs maybe $5 or $10 million to get the first customers out, which in the current environment in this country and how capital has been flowing is not a hard ask.
Right.
Third piece you also do is you play the picks and shovels game. For example, we're doing something in hydrogen. It's in the news and in the papers that the top 4 players, Adani, Ambani, Tata and Mehta, they're in the hydrogen space. So I don't want to be in the hydrogen business that's producing hydrogen or storing hydrogen. I want to be in the picks and shovels business to say if someone's going to war, I want to sell the guns. So that's the other way to then look at a startup and say, what are your disadvantages, what are your advantages, and take those things.
Yeah. Abhishek, so you I think Carpediem does kind of both tech, quote unquote tech investments and non-tech or sort of more traditional. Do you see a shift away from, just because of what we were talking about earlier, that tech taking a beating or something? Do you see a shift happening from the focus that is given on tech, or you think that's going to be as important from when you're evaluating a business? How important does the tech element become?
So for us, tech is means to an end. We are always trying to invest in a company which is trying to create a consumer brand or an organized service. Now, in the process of doing that, it may require tech enablement, so to say. But also, I think tech is also a very badly and widely used word. Like, for example, if you are selling on Swiggy, it doesn't mean that you are food tech. We believe that the opportunity in terms of the Indian consumer landscape is very strong. Tech can be global. It can be in San Francisco, tech can emanate from Tel Aviv. It can also come from Bangalore. But the demographic opportunity in India is something which is very difficult to replicate for any other part of the globe. Now, in order to address that opportunity, you might need to follow certain paradigms. For example, for us, D2C is a channel. It's not a destination. Every brand can have some element of D2C. But India has got many, I would say, core opportunities which are still unaddressed, right? In India, people have created $20 billion companies focusing on adhesives. If you look at Pidilite, it sells adhesives and is a $20 billion company. So we are at the point where there are a lot of core consumer categories which are not being catered to. So the opportunity there is very vast in terms of what you can create. Consumer services businesses trade at multiples which are as lucrative, if not more than SaaS. So that's the central investment theme that we focus on. Now in the process, in order to create efficiencies, you need to hire good people, you need to have great processes, you need capital, you need tech. We do that. We have a microfinance business which has 80% cashless collections, which is the largest, which is the highest probably in microfinance. But for us that is important because it also means that we have the lowest operating cost. And therefore we've been profitable day one. So as I said, tech is important, but for us, we are not investing in tech. We are investing in efficient consumer services businesses. One element of that efficiency is tech, but we don't think that we have the wherewithal to be able to, identify a company which is going to become the next SAP, next Oracle, and that's not our philosophy. But we do have consumer services businesses, some of which have a very impressive tech stack.
So let me move on to another theme which I'd like to touch upon, which is deal making and how we see deal making happening. So Pratik, what's your take? Do you see with what we talked about in the previous theme, do you see an increase in deal closure timelines? Is there going to be more emphasis on due diligence or on business model? Just from start to finish, is deal making going to become more difficult?
Yeah, absolutely. See, while we all are positive on the macro and the relative macro and the investment thesis and the demographics and everything said and done, having said that, with the exuberism fading a little bit, there is definitely challenge in terms of deal making, and we are seeing it. The first and foremost is an immediate intersector shift, let's say, shift between various sectors. So when we call it tech, digital, new age businesses, it actually spans across 10 or 12 different verticals, and each of them can have, again, 2 or 3 more. So, and we have seen that shift happen very, very rapidly. 2 years back, 3 years back, EdTech was the flavor of the season. Today, no one's touching EdTech. Alternate commerce came through its peaks and troughs, and today now that's a sector that needs tons of cash. So do you have someone looking at that actively? No, it's on the back burner because, hey, I'm going to do this check, but who's going to do the next one? So that's the question most VCs ask. Fact of the matter is VC investing is also a lot about momentum and sort of having visibility on what the sentiment that's around. So, and that's where while the disruptions are here to stay, the disruptor and the constituent funding partners may change over a period of time. Hedge funds may go in and out depending on the public markets. VCs may take a back seat, then come back in. The private equities are always consistent. They will remain consistent. And now with maybe the valuations correcting and unit economics shift starting, they could become an active participant in the market. And obviously as a result of all of these changes that are happening, because we are changing the status quo, or at least what was there for the last 18 months, deal making does become difficult. Timelines do increase. The different corporate governance issues that have happened in the space don't help at all. Obviously this was an awakening of sorts where there was an old India where a lot of this happened with traditional sectors, infrastructure, real estate and all. And no one had thought that something of similar sort will happen in this, the more white collar, new age, savvy consumer, and now a lot of that has happened. So that puts a lot of good with the bad.
Yeah.
So that today B2B sectors for that matter, while the companies may be great, the disruption may be great, but just because the optics are looking a little bad, so the fund manager on the other side is saying, see, end of the day, I have to do my job, right? I have to go and go to defend to a global IC. Now what do I say? Effectively that it may happen, it may be there, it may not be there. How do I build my conviction on the space? Because so much is happening around. So might as well just take a back seat, let all this play out for the next 2 quarters, and then we'll see. So this is the same thing, something similar to what we saw in the first 2 to 3 quarters of COVID. Anytime there is an environment, significant event, whether it's fiscal, monetary, macro, or geopolitical, sentiments change. People take a pause to take a step back and see where is going to stop. Can I time the trough, which never happens, but like it happened then, see in 3 quarters, it's already happening now in the 2 quarters that have happened. People start bottom fishing. The people will start looking at down rounds, flat rounds, looking at coming in value. For good companies, there is still demand, but there is demand at a price. So we were saying, we'll wait, let the companies correct. Either they'll time correct or they'll accept a down round. So that's what the deal making is changing. Lastly, there will be a lot of carnage because this clearing that is happening on a lot of not so great things got funded. So today we see our deal pipeline, and in terms of our mandates, the proportion of M&A deals or founders willing to have saying that, hey, fine, run a mandate, take it to financial investors, and then take it to strategics. We are open because we know now there is no other option. So that acceptability is increasing, so which shows a clear trend, right? And that's the trend that we all talked about, that the capital is becoming discerning. It's still there, it's still out there, it's not gone anywhere. The dry powder is still there. It's just similar to what was happening pre-21. So it will come back, just that it may again, like in public markets, it's got concentrated in sometimes in large caps or sometimes in high corporate governance companies. The same thing may happen on the private side, that people will put in more capital behind good companies. Something similar happened on the private equity fund side. Between 8 to 12, 8 to 16, a lot of private funds, equity funds got wiped out because the LP said, hey, instead of putting 10 across 20, I may put 30 across 5. Let me just double down on the ones that are giving good returns, and I'm okay with the concentration. So that cycle is playing out in our view.
I think what I have certainly seen is that, as even on some of the VC deals, the kind of things you mentioned, corporate governance issues, or just the way the industry has evolved, they get as hotly negotiated, and it takes as much time to close even some of the so-called smaller deals as sort of probably bulge bracket or late stage companies are. So it's actually, I tend to agree with you that deal closing may not necessarily just be as fast. Vamesh, I want to talk to you a little bit about what's a buzzword lately, ESG, and as a healthcare focused fund, and for Tata's perspective, how important is it from you? What is an investor's perspective on ESG?
Well, we are largely growth investing focused, and therefore to that extent, the ability of my portfolio companies to adopt ESG is far greater than the VC invest, because they're trying to make, build their businesses, etc. Then you put an ESG spin onto it. It's a bit of a tough ask, in a manner of speaking, if you really want to seriously do and pursue it. You want to pay lip service to it, yeah, you can do a checklist and just be done and over with. But thankfully, at least in my sector, which is across pharmaceuticals, which involves a lot of manufacturing, or even healthcare services delivery, which involves the hospitals and clinics and those chains, we are seeing a significant willingness to adopt that as a way of life going forward. And to an extent, it is also being imposed, if for want of a better word, I'm using that word imposed, on our portfolio companies, because we are trying to be ESG compliant as a fund and therefore underlying our respective portfolio companies. So we are seeing a lot of kind of activity happening. Outcomes are yet too early for people to judge, saying that was it really worth our while. But increasingly, entrepreneurs are willing to accept that as a differentiator when it comes to positioning their companies to say that yes, we are ESG compliant, this is the thing, this is the kind of impact that we are creating, this is the kind of social and governance aspects that we are addressing. So yes,
it's also a lot more nebulous or more difficult to measure compared to some more traditional.
It'll evolve. Like there's this whole big debate about climate change and green gas emissions and all those stuff which is there. Yahan pe bhi, I believe it will evolve. Maybe we are slightly very, very early in the cycle of the ESG sort of life cycle, but definitely there is great value to be extracted by the respective portfolio companies, and which is why we first bought into the whole concept to say that can it really make a difference, and we believe the businesses that we are investing in, since we are very sector focused, we can make that difference and we can demonstrate that impact. So nothing like it if we are able to demonstrate it that beyond just returns, there is this other impact that we have managed to create.
I mean, a large part of ESG is being driven by the fact that if you want to access certain pools of capital, you have to conform to some ESG guidelines. So that's true. But I think if you go beyond that and say that, how can I practically use it? And I say this because we also adhere to certain ESG guidelines. I think one is that it's a great risk mitigation tool. And the second is that if you anyhow do responsible investing, which a lot of us do, I think it just gives you a framework to make it more robust and make it more, a framework that somebody can measure. So those are elements how you can practically use it. Though I think the starting point for most people is that unless you conform to certain ESG guidelines, you are basically shutting down certain pools of capital. That's the reality of the situation.
So Sanjay, Vishesh, I think Amesh's fund is more of a, as he said, probably slightly later down, growth focused. You guys are early stage investors. How do you straddle the line? We're probably the first checks being written for a lot of companies. How do you straddle the line between being an investor and, in a way, being the manager? Obviously, there is a founder involved, but often you might end up having to partake that role as well. So how do you practically navigate that situation?
So idea is, we are not a micro manager kind of stuff running their company. If I were to run company, I would have started one. But the idea is to pick right entrepreneurs and let them do how they want to work across. And we are a consultant which is away but near, right? So on call, we are always there, engage with them on request basis. And whenever we find an opportunity which fits their business, we get them their way. So a couple of places where we are very cognizant about is, trying to help them become more and more capital efficient. So one is that part of it. Second is, in terms of early stage, teams are very, very important. So help them in terms of their hiring side of it. So these are like founders who have never hired or fired. So help them on that navigate. So set those basic foundations, but this is, see, I would put it, these entrepreneurs are like stem cells, right? If you give them right direction, वो अपने आप चलता रहता है. And they are at early stage, they are like sponge, right? You give them anything, वो सब absorb कर लेते हैं, right or bad. In fact, we have seen a lot of the companies fail because of bad advisors what they have within their family. In fact, my colleague partner Ninad, he talks about Chacha ji. बोलते हैं Chacha ji लोग को avoid करो, kind of. So those are the challenges which we see across, right? So yes, the idea is to pick the right team, right? That's where work is there.
I completely agree. I mean, if we were better than somebody else, we should be doing that business. So I think we work with folks who are way better than us, at least in our case, way smarter than us as well in what they're building. And he's right. The idea is to set frameworks and see where you can be incrementally useful. So, and you look at patterns across 30, 40 companies that you've been part of to see if you can open doors on the hiring side or leverage your LP networks on the industrial side to open things. I think if you can help find the first 5 employees, the first 5 customers, that's a very valuable value add in a 0 to 1 journey. So we try to do that.
Abhishek, I want to get your perspective, but from a slightly different angle. You often take significant stakes in your portfolio companies or sometimes even controlled positions. So how do you have those conversations with founders? Does it become a difficult conversation? Because you are not running the business, but still controlling. So what's your take on it?
No, it's, we self-select, right? We, in 3 of our companies, we are the largest shareholders. Hello. So in 3 of the companies, we are larger shareholders than the entrepreneurs. But it was a design which was accepted. Many a times we are partnering professional entrepreneurs. They do not have the ability to put in capital. Now, you could do, let's say, Series A with someone, Series B with someone, Series C with somebody else. The net result is that entrepreneurs end up with whatever they end up with. Sachin and Bini had, I think, 4% of Flipkart, Dipinder at 3-4% of Zomato. So it's not like they end up with some 65% stake, right? Question is that do you want to get diluted by one partner or you want to get diluted by multiple partners? And I think it's easier for everyone if you just have somebody who's willing to back you and provide capital. So we obviously have a more concentrated, consolidated strategy because we end up spending a lot of time with these companies. So we like to spend 3-4 days a month with these companies. We also have a lot of operating background. The partners in the fund, they've been associated with companies like Quest, like Domino's India. So we have deep amount of operating experience, and that is what these people like when they partner with us, right? And they therefore are signing up to it, and that's why we are not very prolific. We do, let's say, 6 to 8 investments in a period of 3 to 4 years. So obviously we can't do justice to 80 situations if we had this strategy. So from our perspective, we select a few people who we can work with. We are co-building companies with them. We are always the second most prominent voice in the company, even if we have the highest shareholding. So we are very clear about that. But we want to be the second most prominent voice in the company. And where we come from is that if you look at our raison d'etre, it's to generate alpha. If you look at classical private equity, while we're early group private equity, but if you look at classical private equity, you will see Blackstone buying Hilton hotels or KKR buying Kone elevators. So unless you have access to operations of the business, it's very difficult to generate alpha. And from our perspective, that is important to us. So we have a model that works for us. We are targeting first generation professional entrepreneurs who know they can put in a certain amount of capital. If they're comfortable with us, then why would they want to go out and fundraise and then we take care of a large number of things for them. And we have to manage a few people rather than many.
Sure. Okay. So thanks a lot, Abhishek. I think we are running a little short on time, so I'll just wrap it up here and open it up for a Q&A. If there's anybody who'd like to pose any questions to the panelists. Yeah.
Yeah, hello everyone. My name is Munish Agarwal and co-founder Tattvam Valuers, part of Tattvam Group. So my question is, exit is very important aspect of investing. So when you are doing a public investing, you have a clear exit. When you do SIP, say 10 years investing, or that you have a fixed period. So when it comes to private investing, when I say private investing, I mean investing in startups through AIF or through VC or through direct investing. So what should be, in your view, an ideal exit period, and what are the avenues of exit? If you can throw some light on that.
So there are 3 avenues typically for any startups. One is the best exit, which is if a VC is buying your stake, which is a financial exit, right? Somebody who believes that this will grow multifolds and you are handing over your equity, that's the best exit. Next is corporate one, which is going to be you get some value, but not like out of the world. The lastly is an acqui-hire, where you just salvage your capital. So corporate exits are typically where corporates will give you around maybe upwards of 20x, but below 50x kind of. I've not seen great exits on that. Large exits which I've seen is with the financial ones, which is upward of 100x for early stage investing. Acquire you get 1x, 2x, salvaging whatever capital you can. That's how it works.
And ideal period of investing in the startups? Any thumb rule or, you know?
So at least you should have an holding period of 7 to 10 years. That's a vision which you have. But if you see the asset getting destroyed or the capital not there, so might as well initiate and do some salvage, doing an acqui-hire. If there's a great offer and you believe that, you know, this is a company you would not like to continue and, you know, founders are aligned, do a corporate kind of stuff. If you are forced for an exit many times as a, you know, investor which is early stage with a large incoming investor, you take an exit on a financial if it suits the work.
And that's for a startup. I mean, we, for example, we come into companies which have written $5 and $25 million in revenue. So we have, we look at either a sale to a financial investor, in the odd case an IPO, or a strategic. And one of the reasons why we take a significant stake in companies is because we can do strategic sales. So earlier this year, we sold one of our portfolio companies, a company called Yantra, to Flipkart, where we, along with our co-investor, we owned 73% of the company. So, as you rightly said, exit is important, and that is why one of the things that we want to do is we want to control the cap table to the extent possible, so that at least just because of diversity of mindsets, an optimal exit is not sort of, you know, upset.
Thank you.
Anybody else?
Hey, hi. So I have the question for the panel as a whole. So, you know, so we've had the entire, a lot of the rhetoric here has been about the funding winter, right? You know, and if you go back like six months ago, or, you know, you had the Y Combinator letter that was issued saying, warning founders about a possibility of a funding winter. Then in parallel, you know, you have the biggest VC funds in the world raising or announcing funds crossing, you know, sometimes $1 billion in prospective money to be implemented or invested in the companies. So my question generally is, you know, is it a, you know, a funding winter that we are looking at, or is it a correction, you know, to the heavy money, to the extensive amounts of money that was invested, you know, 2020, 2021?
So I think funding winter here, not there. I don't know, but fear is here. So, sab log dare hue. Nothing like you go out in the streets here. India is bustling. Car bookings, you got a waiting period. What is not happening in India? Everything is bustling. I don't know about funding winter.
Yeah, exactly. So on the ground situation seems all hunky-dory, at least all consumption and macro and everything is, or micro rather, is all seems to okay. But like we said, there is a fear of the unknown because of the rate hikes and the inflations across the world. Something similar to what we saw in COVID, right? And then that's again going back to the same learning. It's not very old. I'm not saying look at the 3 or 4 down cycles. Just 2 years back, we had the same situation where for 3 quarters, it lasted 2-3 quarters, and then it came back with a great vengeance. And both the public markets and the private markets. We are down 1.5 quarters. Let's see how long it lasts, because as you rightly said, capital is there and the opportunities to invest are there. The correction, yes, has to happen because the whole paradigm is shifting. So it's just a matter of time. Now that time, what is that time? That no one knows. And that's where the fear of the unknown lies.
I mean, we made no investments last year. This year we might make 3. So from our perspective, it's a great time to invest. But I think what happens is that since you don't hear statistics like 100 unicorns have been created this year, we feel there's a funding winter. But I think that valuations will drop, but I think at least the private equity side of the capital will probably end up doing more deals this year than they did last year.
अगर बुलिश है तो बबल है अगर नहीं कर रहे तो बोल रहे विंटर है विंटर
I'll give you a very interesting anecdote on this. During a process, we went through a situation. If there are 3 companies in a sector, right, and if for 2 years none of the 3 companies have raised capital, then investors are saying, like, looks like the sector is out of flavor, right? And one of the founders will say, okay, that's fine. And then let's say in a year, if the 2 other companies have raised twice, or the third one has raised 1, then the investors will say, oh, but there's too much capital in the sector. So in either case, we are not going to fund you. So one can sympathize with the founder and the team, right? But there is no right answer. So there are always reasons to sort of swing to both sides. It's just that someone or the other will see value in what the founders are building, and will hopefully be able to fund them.
I think you need to rephrase your question. There's no funding winter. There is a winter in the minds of the entrepreneurs who raise money at some stupid valuations and now are failing to be able to reassess their positions. To say, hey, shit, man, I need to raise it at a much lower valuation than that. So yes, it's a funding winter in the mind of the entrepreneur. Investor, I'm sitting on $100 million. I need to put that to work over the next 2 years. So there's no winter.
All right. Thank you very much for all the panelists, and move on to the next session. Thank you.
I request you all to stay for a group photo. Thank you for the questions, and thank you to the panelists for such a useful, for their useful insights. So we'll start the next panel immediately. But feel free to, grab a cup of tea or coffee just for a short break, and please come back.